You buy a stock and then boom, overnight it drops 30%. What the just happened? Well, the most likely problem is you bought an overpriced stock. You know the strategy is you got to buy low and sell high. Duh. But how do we actually do that with stocks? Well, if you're not using this one metric, the PE, you're investing blind because you have no idea if the stock you're buying is cheap or expensive. So what exactly is the PE? Well, it's a valuation metric that tells you how much you're paying for the business's earnings. But there's also a catch. You can't just go out and start buying low PE stocks and selling high PE stocks because that'll also get you in trouble. So here in this video, I want to show you how professional investors use the PE and how you can use it to pick cheap stocks that do well and really learn to buy low and sell high. So let's dive in. So what is the PE? When you first look up a stock on Google or Bloomberg or FactSet, you're going to see a lot of information. You'll see the price of the stock, the volumes traded, the market capitalization, and then you're going to see the PE multiple. So that's short for price to earnings. It's the ratio of the stock price versus the earnings per share of the business. Now, what that's like is if you go to a grocery store and you see a selection of chips or crisps in the UK or prawn crackers and namkeen in Asia. And usually there's a small bag and a large bag. Now, if you want to know which is cheaper, you calculate the price per ounce or gram, the per unit cost. Sometimes grocery stores will just display that on the price tag. So say the bigger bag is 10 cents per ounce and the smaller one is 15 cents per ounce. Well, now we know that the bigger bag is cheaper. So the PE multiple is like the price tag for the company's profits. The higher the PE, the higher the price you're paying for the business's earnings. Now, there's other multiples like revenues, EBITDA, or free cash flow. They all work exactly the same way. But the PE is the simplest and easiest metric to start with. Here's how it works. Say we have a coffee shop. Let's call it Buffett's Coffee Shack. Now, this coffee shack is making $1 million in net income. That's the earnings of the business after paying all of its costs. The price of the business on the market is $10 million, so $10 a share, and it's got 1 million shares outstanding. That 10 million price versus 1 million in earnings is a 10 times PE multiple. You're paying 10 times for each dollar of earnings. That's the price of Buffett's Coffee Shack. We typically use earnings because that's how shareholders can get paid. Earnings can be used to pay dividends, or it can be retained by the business, which increases the stock's value. So the PE helps us to compare the price of different businesses. So down the street, say there is a competitor, call it Ackman's Java House. That's selling for a 12 million price versus 1 million in earnings. So it's a 12 times PE multiple. So Buffett's Coffee Shack, which is 10 times PE, is cheaper than Ackman's Java House, which is 12 times PE, right? Well, not so fast. The net income or the earnings is what these coffee shops are making today. It's most likely last year's results. So it's a backwards looking PE. Say Ackman's Java House has just opened a second location and they're projected to make a net income of 2 million next year. When we use those earnings, Ackman's Java House is now a 6 times PE, so a 12 million price versus 2 million in net income. So now it's cheaper on a forward-looking basis. Now, if we're buying these businesses, it's the future profits that will make us money. So the forward PE is a better indicator of the price of the business. That metric will help you see if the stock is cheap or not. When you're looking at stocks, it's best to use the next 12 months, or NTM for short, PE multiple, which is based on next year's earnings. In some cases, you might use up to a 3 to 5 year PE multiple. But the problem is, as you look more and more forward, you're relying more and more on a forecast, and that forecast can obviously be wrong. So when looking at the forward PE, we also have to start to weigh how reliable that forecast is. In this example, whether Ackman's Java House can really make 2 million in net income with that second location. Now, there's two ways to use the PE to buy cheap stocks while also considering the future. It comes down to two philosophies for investing. The first is buying stocks with low PEs right now. So say I'm going to look to buy stocks that are 10 times PE or less. I'm going to focus on businesses that are very stable, because as long as the earnings stay at that level, maybe they go up slightly, then 10 times for a stock is cheap. And I'm going to buy it because I think that business is worth 12 times PE. So I can make 20% next year or maybe the year after if the PE revalues. So that's your traditional value-oriented strategy. You want to buy cheap right now. Now, the second way is buying stocks with a low PE for the future. So say now I'm going to look for stocks to buy at a 15 times PE or less. But now I'm going to focus on growing businesses. Because if the business can grow its earnings 10% every year, by year 5, I'm actually buying a 10 times PE stock. And I'm going to buy it because I think the business is actually worth 15 times PE. So I can make 47% in total returns over the next 5 years as the business grows. So that's your traditional growth-oriented strategy. You want to buy cheap for the future. So when you're investing, you're always weighing what you're paying for earnings now versus what you're paying for earnings in the future. Sometimes the value approach works better when you get earnings up front, and other times growth approach works better when you're getting earnings in the future. The technical reason why value strategies tend to do better sometimes is when long-term interest rates are high relative to short-term interest rates. It makes cash up front more valuable than cash in the future. So you really just want to lean into what makes more sense to you. Do you want to buy at a discount, or do you prefer to buy something that can grow in value? But either way, the key to successfully buying is understanding what you're paying for, which is the business. So how do we use PE multiples for real companies? Well, say we're looking at Google, which today is about 18 times PE, versus JP Morgan, which is 12 times PE. Does that mean Google is more expensive and we should buy JP Morgan? Well, not quite, because they're not comparable. Google's in the tech business, they sell digital ads. JP Morgan is in the banking business, they do lending, they do manage assets, they do transactions. So they have different growth patterns and different business models. So they're valued differently. It's like comparing the price of a sports car versus a pickup truck. There's different uses, so there's different prices. Now, so to use multiples to check if a stock is cheap or expensive, you need proper comparisons. Now, the first way to do that is to compare it with history. So Google's current PE multiple of 18 times is low compared to its historic range over the past 10 years of 18 to 30. So it's cheap versus history, obviously assuming the growth is similar. So that's like looking at the discount section in a store where you're looking for items that are marked down 20 to 50% lower versus the original price. The second is to compare with its peers. Say we look at the PEs of large internet tech companies like Meta, which is 23 times, Amazon is 31 times, and Microsoft is 27 times. So Google's 18 times PE multiple is also cheap versus its peers. That's like comparing clothing brands of one item side by side to see which is cheapest. So once you use the right comparisons, then the multiple can tell you if it's cheap or expensive. So does that mean if I buy a stock that's a low multiple versus either history or its peers, I'm getting a discount and the stock's going to make me money? Well, not exactly, because you can actually lose a lot of money doing that. Think about your experiences shopping with low price stuff. So for example, for me, I hate shopping in the discount section for clothes because usually in the past, if I buy something, I've realized later it's an ugly color, it's a terrible style, and that's why it's never sold. Same thing happens when I buy cheaper brands. If I buy a cheap pair of shoes, sometimes I'll realize later the leather is really shoddy and it just falls apart a lot faster. So it's the same with stocks. Sometimes you just get what you pay for. So I saw this firsthand when I was covering Apollo Education. So this company ran the University of Phoenix, which is a large for-profit college in the US. Now, at one point, the stock traded at a 5 times EBITDA multiple, which is low by any comparison. But the business was in serious trouble. The US government had cut funding to student loans for its programs, so enrollments fell off a cliff. It was stuck with campuses and with costs it couldn't cut, so earnings just kept declining, and so did the multiple. The stock only bottomed when someone acquired the entire business at a 1 times EBITDA multiple. So a low multiple can mean a cheap business, but it can also mean a lousy business, and the price can keep going down. So you don't want to go out and just buy low PE stocks and sell high PE stocks. That's honestly a recipe for disaster because your portfolio could just become a collection of terrible businesses. So here's how to use the PE effectively. So if you're looking for cheap stocks, what you want to look for is a good deal, like a forced clearance sale when a shop closes down. So that's the equivalent of buying when the entire market is selling off. Or say buying a piece of property that you know can be fixed up and is a hidden gem. So that's like buying when a business when it's temporarily beaten down. You want a discounted PE multiple before a great business. So Netflix, for example, was once a low PE stock. Back in 2022, the stock tanked. For the first time in over a decade, its subscribers dropped by nearly 1 million. And it looked like a lot of its key markets in the US and Canada were already saturated. There was no room for new subscribers. So analysts call this growth story done. The stock dropped all the way down to a 15 times PE, which is far below its history. The 5-year average was 50 times and far below peers like Disney, which was 22 times, Warner Brothers, which was 28 times. That low PE reflected a no-growth business. But the company put in place a recovery plan, introduced new content like Stranger Things, which did really well in the US. It cracked down on password sharing to add new subscribers, introduced a cheaper ad-supported plan, put in place price increases and paid sharing plans to increase the revenues per user. So the business started to recover, and now the stock offered a discount for that potential growth. Now, with earnings growth coming back, there was an opportunity to buy the stock at 15 to 20 times PE, which is a fairly cheap price for a growing business. And once earnings started to grow again, the company was actually more profitable after the cost cuts. So Netflix was looking like a great business again. So the stock's multiple went all the way up to 30 times, which is normal for a growing and profitable tech company. So the stock increased 65% in 2023, then another 45% in 2024, because the PE multiple expanded and the earnings per share went up. So that worked because you're buying a great business at a significant discount. So to buy cheap stock, you always want to look at the business first. You want to at least have a good earnings outlook. Or if the business has been beaten down, you want to be looking for some signs of recovery in the business. Then you look at the PE multiple to help gauge if it's a discount or not for that growth. It's a great business plus a discounted multiple. That's how you get a cheap stock. So there's other ways that you can also use the multiple in the decision-making process. The PE is really a price that reflects what investors are willing to pay for the expected earnings or assets of a business. So once you understand that PE also just reflects investor psychology, you can use it to time decisions. Professional investors use the PE multiple to time when to buy and sell cyclical stocks. So cyclical companies are sensitive to the economic cycle, like Robert Half. It's a staffing company. Its business tends to move up and down with the employment cycle. So you want to buy the company after an economic contraction. So when earnings are low, you want to write it up and then sell it when the economic cycle is at its peak. So when earnings are high. The PE multiple is one of the indicators for those turning points. You want to buy staffing stocks at a high PE, so 25 to 30 times, because that's when the earnings are low, but the price is starting to reflect a better outlook. You want to sell it at a low PE, like 10 times or so, because that's when earnings are at their peak and the price is starting to reflect a coming decline. You can double your money in a year if you buy and sell cyclical stocks at the right times. This is counterintuitive, right? So sometimes you do want to buy high PE stocks. The same strategy also applies to other cyclical stocks like industrials or even semiconductors. So final takeaways: to make good investment decisions, you always start with the business first. Understand its fundamentals and its prospects, then you can use the multiple to help price the stock. You can use it to gauge whether it's cheap or expensive and also to look for good deals. But look for a good company first, then look for a low or reasonable PE. That's how you buy low and sell high. I'm going to leave you with some advice from Warren Buffett, who said, it's better to buy a great company at a fair price than a fair company at a great price. Thanks for watching. I'll see you in the next video.